Hello and welcome to iNurture videos. In this video, we are going to discuss the circular flow of income. After completing this video, you will be able to discuss the circular flow of income. Income circulates between an economy's two main components, its households and firms. Households supply firms with factors of production. In returns, they receive an income. Income is converted into expenditure, which is received by firms as revenue. This spending generates an output of goods and services from firms to households. This is a simple circular flow. Income circulates continuously between households and firms. The monetary value of income expenditure and output should equate. For example, if factors together an 100 billion units of currency as an income, and assuming they all spend their income, the value of household, expenditure, and firm's output is also 100 billion. Each time income circulates between firms and households, it creates jobs, spending, and output. However, some income mainly out of the circular flow in the form of the savings. This reduces the amount of spending which continues to circulate. For example, if 20 billion is saved, then only 80 billion continues in circulation. Financial institutions have evolved to accept this unspent income in the form of bank deposits. As income circulates and firms produce more output, machinery and other capital erase outs and new capital is required. This may be funded by borrowing from the financial sector, which holds the economy's unspent income. Investment spending represents an injection back into the circular flow. In this way, savings is returned back to the economy through investments. A second leakage out of the circular flow is taxation, which is paid to the government. When taxation is spent on public goods and welfare transfers, it is injected back into the circular flow. Taxation is greater than spending, which creates a fiscal surplus. Spending may be more than tax revenue, which creates fiscal deficits. Borrowing may be required to make public sector finances balanced. Finally, spending on imports reduces the domestic income circulating, while exports is an injection into the domestic circular flow. Payments between countries for goods and services can be balanced. However, import spending may be greater or lesser than export revenue, creating accounts deficits or services. Thank you for watching.